on my $10 mic, or whatever it is. All right, Clint's here, Jet, GSTSG. Oh, wow. What a huge compliment, man. I don't even know what this thing is. People laugh at me because I got this really cheap headset. I think I got it at Best Buy years and years ago, but somebody just the other day was saying that it was like, wow, what kind of mic do you have? It's amazing. It's just like this flimsy little thing that I have to get the mic in the perfect spot or else it crackles and pops and everything. So yeah, I'll try not to spit into it. Good. All right. So usually when we do these boot camp things, I kind of have more of a structured approach where I try to share with everybody what the sort of foundation of what the traders in the DTG dojo, as we call it, tend to look at in their trading, which is specifically market structure, meaning key levels, structures in the market that are going to attract a lot of participants. That gives way to price action, which is how the market pushes and pulls, as we call it, within those areas, and then narrowing it down further to what's happening in the book and on the tape specifically, which a lot of people just lump into one and call order flow. So typically I will sort of do a layout of how a typical trade idea is born from those three things, and focus on the process, okay? But I didn't really have a chance to prepare a lot of stuff. I was in Miami this morning on business, and I drove back, and it's just been a crazy, hectic time. And as I was driving back, I was trying to think, for once, instead of doing what we usually do in these boot camps, what could we talk about that I think would really be more valuable to the participants, since a lot of you, I assume, are fairly new to trading. And when I say new to trading, you probably haven't been at it for 5-10 years or more. Am I correct in that assumption? Or even if you have, maybe you haven't been very successful with it. Yeah, okay. So that's pretty good for you if you've been at it a while, Jet. I've seen you, I think, before too. So, and what I came up with was that we've been talking about something lately, which in our community, it's just come up a lot, and it's come up in conversations, with us privately too. It's just been sort of a phenomenon that it's been interesting to watch, and I think anybody who's been around the game for a long time would agree with me that this is sort of a cyclical thing that comes around, and what I'm talking about is what is the darling child, as I call it, of the sort of short-term trading community. What's the new hottest thing that everybody's looking at or is interested in? The markets, in many ways, to our belief, are exactly the same as they've always been. They're auctions that attract buyers and sellers as participants, and ultimately the psychology of fear and greed plays out in a variety of periodicities in a variety of different ways. So a lot really hasn't changed, but there are sort of these cyclical things that happen as we move through time. And I remember sort of what I'll call the real start, kind of like the apex of what we've come to refer to as the the sort of the rise of the internet trader. And what I'm talking about when I talk about that is people who have come into the game late enough to where they see a market as a chart. Okay, so we had an explosion of software tools, and obviously Reg NMS and the rise of electronic trading, high frequency trading, and as the technology has become better and better, the race to zero, as we call it, where the execution efficiency gets better and better. So the tools that are required to be able to capitalize on that efficiency get better and better. And the level of granularity that you're able to see the markets has just exploded. And the first kind of wave of that was the sort of the indicator generation, where all these great tools come up and everybody had broadband execution and everything's really fast, and you could analyze the market in these wonderful all-in-one tools in a million different ways. And this gave rise to people obviously looking over histories of charts and trying to identify patterns, and in some cases trade discretionary off those patterns, in some cases trade quantitatively, and we've participated in that ourselves. A lot of you know that we also on the pro side of the house own a quant research and development firm, so we've definitely been knee deep in that explosion in terms of chopping up data and analyzing it in the broadest sense. So when the indicator explosion happened, what you saw was all of these software vendors, jockeying for position and competing and saying, well, yeah, they have that, but we have this. And with this software tool, you can only do this, this, and this. And with ours, we have all this extra stuff that you can beat up patterns and price information, and it's going to somehow give you an edge. So we saw that really explode sort of through the mid-2000s and continued. And what's interesting is that we sort of accidentally were at the forefront of the next thing, the next explosion of the cool guy stuff, particularly for intraday futures traders. And that's the rise of the order flow generation of internet traders, still seeing the market as a chart, but now it's all about reading the tape and reading the book. And we have to chuckle when I say we're at the forefront of it. Back when we made our space on the web that we used to communicate in our own little crew public, we were asked to do a webinar series for a great software program called Market Delta. I'm sure you guys, a lot of you are familiar with that. Great piece of software. And we did a 3-webinar series, which sort of gave rise to us opening up our little community to a limited number of retail traders that also interacted with us. And we'll talk about all that in a while, and what the purpose of DTG really is. But so we did this webinar series, and we were amazed at well, let me back up a second. So in this 3-part series, the last part was the sort of nitty-gritty of people were looking at Market Delta, seeing all these numbers and crazy stuff on the screen, saying, what am I supposed to do with all this? It's just completely overwhelming, just like putting a boatload of indicators on your chart and wondering, well, how am I supposed to process this information? Trevor, admittedly was saying that was the case, and I guess what we did inadvertently in that 3rd webinar that we did is sort of cut through and say, well, here's some simple ways that you might subdivide the data into very simplistic concepts that a tape reader might be really interested in knowing about. And being that way before these tools were, tools as slick as Market Delta were available, we were, very interested in the tape. But we sort of saw tools like Market Delta. When I see a footprint chart, what I see is just a giant history of the tape. And to me, I've always called tools like that memory tools, especially as you get older. It's harder to keep track of things like you used to when you were younger and be really sharp and remember uh, what the trading was on the first push to test into this level, and so on, or whether size was participating, and what locals or short-term discretionary traders making those markets were doing versus what paper was doing, or institutional traders, longer-term traders. And so all of a sudden you have these great tools like Market Delta, which just give you this wonderful running history of the tape, so that you can always see contextually not only what is happening right now, but what has been happening recently, and even what was happening 3 weeks ago, the last time this particular market structure was tested. So we were definitely big champions of tools like that. And then similarly, we had another wonderful memory tool be created by a guy named Peter Davies, who started a software vending company called Jigsaw Trading. And essentially what he did was just take it to the next level, except with the order book, the tools that related to the order book, as opposed to just the tape. He has the tape tools in there also, but sort of an all-in-one solution on your dome, or your depth of market display, where most futures traders like to enter and exit the market with some sort of a ladder based execution tool, which some of you guys know, a company called Trading Technologies created years ago. So what Pete did was apply the same kind of historic concepts to the order book, where now, especially if you were a extremely short-term trader, a scalper, or a market maker, liquidity provider, as I happen to be, whether you're an outright trader or a spreader, which I also happen to be leaning towards, you had the similar beneficial component of not having to constantly remember in the speed of the auction what's happening, particularly to the inside order book, or to the order book adjacent to whatever the current inside has been. You have top third of the book, HFT market makers been pulling or stacking. What's generally been happening is price prints into a specific level. Are the trades of the aggressors being absorbed or not? Are our market makers pulling out of the way? Which obviously is very valuable, especially for the next tick or two. So first we sort of saw the Market Delta revolution that Trevor started with his wonderful creation of the footprint, which is simply just taking a candlestick chart, for lack of a better term, widening it out, making a big wide candle, and then taking every single price that the candle prints and showing you the total print count, which you can also further filter by the size of the trade, trading into the bid and trading into the offer. So we saw that sort of proliferate, and probably much to Trevor's dismay, have a lot of imitators. And then recently, or more recently, we've seen the same thing happen with the order book tools, where there's a lot of software vendors that are offering similar things. And in this proliferation of software tools that are related to order flow, obviously form follows function, right? You then get trading educators, and I use that term, I guess, fairly loosely. There's sort of a lot of things, I suppose, that you could lump into trading educators, but we saw this sort of naturally. It's just a market like any other market. Trading educators basically step up and realize that everybody's like, wow, if I'm going to be a successful futures trader these days, I really gotta have the best tools, or like D-Boy always says, what's his saying? These are not your father's charts or something like that. So, form follows function. People who want to get into the, what they think is the apex of the game or at the top of the game, have the best information, seek people who can teach them how to use those tools, right? So you have this big, swath of trading education sort of filling that space. But unfortunately, and I'm not saying this is malicious, and I'm not picking on anybody, and don't ask me to name names, because this is not a any kind of a mudslinging thing that I'm doing here, or trying to belittle trading educators that do certain things, but rather just to educate you of the trap of yourself, as it's related to your own trading, where in this sea of trying to get the best information, you can inadvertently process that information in a way that is not only not going to give you an edge, but is going to put you in that same trap that you were in before, when you were trying all the indicators, trying to find something that quote unquote worked. And then you've just basically done something that we call method hunting, which is just, you've morphed over from this indicator stuff into, oh, now I know, now I've got the order flow tools. And unfortunately, like I said, inadvertently or maliciously, there's a lot of charlatans out there too, are saying, we know that this is a hot button. We know that this order flow stuff is what's on everybody's mind. So here's what I'm going to do. I'm going to put up my little trading education site, and I'm going to tell everybody that I got this whiz-bang little quant that shows these patterns and identifies them, and we call it red light, green light. And it's no problem. You won't have to think for yourself. You won't have to really understand the market. You could just see, you could continue to see the market as a chart. And not only that, we could take it one step further, and you don't have to think at all. It's just, when it's time to buy or whatever, we've got a little quant here that's going to put a nice little green arrow there, or red arrow, or whatever, whatever it is. And like I said, it's not always malicious or anything like that, but you do need to be aware of this. Wait a minute, what am I doing here? Am I paying attention to the right things? And that's sort of, is a good segue or transition to something that really is the crux of what we do, sort of the purpose of Discovery Trading Group, amongst ourselves, all the other participants, in the community, and everything that everybody talks about, is that just like with indicators, with order flow, there is no magic bullet. There's no red light, green light. There is no edge in any form of trading that comes directly from the way that you enter the market. And this is so permeated in the minds of most traders, because it's a very natural thing to try to zero in where do I enter, what's that, and then you get this positive reinforcement of looking back and seeing, well, look, see, if this tool showed this, and the market did bounce, so that's an edge. But your mind sort of plays tricks on you, because you leave out the most important thing, which is the relativity of your risk and bankroll management model that you're overlaying onto using that tool. No different than an indicator. And I'm here to tell you, some of the most successful traders in the world continue to be using tools like moving averages, like stochastics, like RSI, like VWAP and TWAP. How you want to segment the market into trade events is almost inconsequential. What's important is a few things. First and foremost, that you are coupling whatever your entry criteria is with a risk overlay that is not only appropriate for whatever that entry criteria is, but also that is one that can be adaptive to market changes, specifically to changes in volatility, and perhaps even more importantly, something that we're always talking about as people in our community are developing their models and figuring out how to adapt them, is context. What is the idea that, oh, that's a good trade, or this is a good entry, or that's a great spot to enter the market is a really ridiculous statement, for a couple of reasons. One, again, what's in what context? What's your objective for the trade? Are you going to be in the trade for the entire day? Are you going to be in the trade for 5 handles? Are you going to be in the trade for 4 handles? Are you going to be in the trade for 2 ticks? No, it's going to be for 3. All those 3 ticks, all those little changes to the risk overlay, or what's your hard stop point, or how are you going to trail the position, all these things can drastically influence the result of that one individual trade. So we have always advocated, it is certainly something that we've always done and do with our own trading, whether it be long-term position trading, swinging, outright, spread, scalping, market making, liquidity provision, everything that we do, we're always considering, that adaptation and changes in market context, because there isn't any one size fits all. And you want to try to avoid the trap, because you get these cool software tools and you look and it's like, oh, look, the market's rallying and it's coming up to this point, and according to my tool here, there's a boatload of sell side liquidity up at this level. And like I said, whether you believe it or somebody's telling you to believe it or whatever, well, that means it's a quote unquote good time to sell the market, because there's a lot of sellers up there. Buyers aren't going to be able to break through it. The market's likely to rotate down, et cetera, when it hits that dense liquidity. Well, that may be the case, but for how long, or if at all. We like to use the term, the deck is constantly being reshuffled. I think it's something that everybody who comes in this game has to have a really firm grip of and understanding of, is that, look, whether you like it or not, if you're going to be a trader and you're going to do this for a living, you're going to have to come to terms with the fact that you are a professional gambler. That's what you're seeking to do. And a lot of people don't like that word. And I'm sorry that for anybody who doesn't like that word. At the highest levels in the game, the tier 1 market making firms, believe me, every one of the PhD rocket scientists, all the way down to the most accomplished discretionary traders that don't know anything about quantitative research, all know that that's a true statement. That just because you're gambling doesn't mean, like any professional gambling pursuit, that you can't have an edge. But you have to be very clear that that edge isn't going to come on a trade-by-trade basis, based on exactly where you enter the market with all of the other components ignored. We like to look at groups of 30 trades, or a month's worth of trades or more, when we analyze how our risk models are working and how they're adapting. Because in any one trade event, think about it. If you look at, there's a screen share that says DTG sheet and charts or something to that, or sheet and, let me see what it's called. Yeah, sheet and prints. Can everybody see that? Bootcamp, DTG, sheet, prints. Okay, good. So, like I said, I don't want to go too much into this, but let me give you sort of the cliff notes. Okay, this was a place we do example trades daily in the community, and all members do too. These are just the ones that we do, NJ and I as well. Sometimes, the value in them, in fact, oftentimes the value in them is not illustrating, well, here's a great trade that we took that made a bunch of money or whatever, but rather illustrating the concepts. And that's what the annotations are really about, sort of reinforcing these concepts of the decks being reshuffled, and, things can change. So we're really into the concept of relativity. So depending on how thick the books are, how much volume is trading today, what the activity is, what's going on, is the market news driven, et cetera, et cetera. The typical prints that you see at price in a market, have a cadence or a certain pulse to them on a given day. So what we're interested in, one of the things that we're interested in is when the amount of those prints, particularly at a key, approaching a key level or at a key level that we're really interested in identifying, is when those print counts really start to swell. In this case, the market was moving down, and the reason that the prints swell is because the sellers are aggressive and they're hitting into the bid side of the market. But market makers are realizing that this is a place where the market should probably start firming up, so they're swarming in and actually absorbing that short liquidity, which causes the market to stall. When the market stalls, the previous shorts realize, maybe it's not going to go down anymore. They decide they're going to get out. How do shorts get out of the market? They lift offers, they hit the offers, then the market starts to firm up, rotate up, and so on. So just one of the many things that you see. That's the first blue box. You actually see that happening on the left. Market rotates up a little bit, pushes back down. Now we see seller exhaustion. You see the smallest prints at the bottom. The print counts in green. You don't see a lot of prints there because the shorts are realizing the market is firming up. No new shorts want to come in. Believe me, there's plenty of liquidity there from market makers who would love to take the other side of them. They're not all getting filled because those shorts are just refusing to hit those bids. That's called exhaustion. When the market exhausts like that, no place to go, at least in the short run, then up, so on and so forth. But in this particular example trade, even though we happen to be short bias in this particular day, at this particular time, it shows that there were a lot of reasons that buyers could have found to buy the market. And that on this particular trade event, that the market decided to roll over and continue down in the same direction is a function of the market being a living and breathing organism. It's constantly assessing what's happening, processing the new information, and how that's reflected in price action, which is shaping the collective decisions of everybody who's about to trade or adjust their trade or whatever. It's very, very complex is the point that I'm trying to make. So the idea that you would go into a process that you're all giddy-eyed over order flow and look at this is great. Wow, the prints swell up here and it really shows the market's firming up and this is great. Man, I never had tools this cool. And then you get in and let's just say for whatever purpose, well, I trade with a blah, 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 a 3-handle stop and a 6-handle target or whatever you typically hear from fixed tick traders that are not adaptive. Well, what the danger is that they get into this trade and then maybe the next 8 trades are exactly like this. And they get in, the market's firming up, everything's looking good, blah, blah, blah. It never reaches their target. It rolls over and stops them out. And then a month later, they come to the conclusion, well, this doesn't work, and I'm holding air quotes on work, right? Why? Because they haven't considered the relativity of the risk model. They haven't considered that the deck is being reshuffled. They haven't considered that it's not about one trade. And unfortunately, they could get all starry-eyed about these order flow tools and then end up not being a trader or blowing up or whatever because they didn't approach using the tools from the right mindset of understanding that this is what markets do. So this is kind of what we're showing there in purple. So this next box after green and purple, great. The market's coming up. I don't have the stats shown below, but the stats below was showing that larger traders, 50 lots and higher, were lifting offers and punching the market out of this low. Well, guess what? The majority of them turned out to be wrong. It came back up to the backside of the structure right here, and you see it just immediately hard rejects the highs after absorbing buyers. You could see 3,400 prints there on the offer side. That's aggressive buyers hitting those offers, and despite the fact that this hard lift is going on, it's immediately stalling. So that's how markets are. What the reason is inconsequential. Whatever the reason was, people are processing the information, the participants in the market, and it stalls there. So now, how do those longs feel that got in the blue and the green? Well, now they're getting a little bit nervous. Market pulls back a little bit. Okay, maybe it's going my way. It pushes up again, fails to retest that high in purple that we just made in the red, and then aggressively, the sellers come in, and the previous buyers are puking out. That's what's fueling the move down. Market makers pull out of the way. Just to the right of the red, just below the red box there on the next bar, you can see where the prints are very thin on that move down. Market makers know that that's what's happening, pulling out of the way, not willing to execute on the bid side, which causes the market to be able to drop very quickly. Again, who cares? The point is that it changed. So if you were long, if in the context of your risk model, your particular overlay, whatever that was in terms of a target, what your risk was, whether it's adaptive, whether it's dynamic and you're actually trading the flow in real time, whatever it is going to influence the outcome of every individual trade. So when you think about building an edge, you think about it collectively over time, over groups of trades. And that's really what the DTG Collective is really about, is about traders constructing. I would say most of them are market structure, price action, and order flow traders, although not everybody trades the S&P. We have currency traders, crude oil traders, interest rates, even long-term swing traders, position traders, everything. But the idea being that the intersection of whatever your entry criteria is with the risk model and the bankroll management, your trade size and all that stuff, is where the rubber really meets the road for any and all professional traders. And it's it's funny because you could say to somebody, if I said to you, I have a risk model that uses a 2-point stop and a 4-point target, and I said to you that I'm going to overlay that risk model, and the entry criteria that I use to execute that risk model doesn't matter. You'd laugh at me, right? You'd laugh in my face. Well, it works the same the other way around. To say that an entry criteria or a specific set of order flow tools that's indicating something, that's a key word, like an indicator, right? It's indicating that something is happening in the market. Right now, it's happening. There's no question that what's happening on a tick-by-tick basis is evident when you use order flow tools. So if you're a tick scalper, for the next tick, I'm not going to argue with you that it can be a very predictive tool. And that just happens to be what I spend most of my time doing intraday. However, the risk model matters for that too, of course. So, you can't, it works both ways. You can't overlay a risk model and say the entry doesn't matter, and you can't have an entry criteria and say the risk model doesn't matter. The relativity of those two components, along with the market cut, what's the market doing? Is there news coming into the market? What's the general sentiment? Is there momentum present at the time? All of these moving components are important, and that's why I really thought that the main thing that I wanted to do in this talk was to kind of remind everybody that don't be starry-eyed about order flow tools any more than you probably, it's kind of funny because indicators were all the rage for a while, and everybody's indicator this, indicator that, this indicator, that indicator, this indicator, and I'm talking about indicators that use a parameter to dissect historical price information as a predictive tool for the future, whether it's single indicators in combination, multi-time frame charts, market profile is used as an indicator oftenly. Elliott wave, Gann, all that stuff. The contextual information is just as important, if not more important. And it's interesting because in this sort of cyclical wave that I talked about in the beginning, where it was all about indicators, and then it's like it's sort of all at once, eventually everybody goes, oh, indicators don't work. What you really need is order flow tools. And now we're sort of, we're mired in that thing where there's all these people starry-eyed about order flow tools, just like they used to be about the indicators. And so hopefully that will subside, and people will get smart about all of these contextual pieces of the puzzle that are going to be important with any professional gambling pursuit. Trading really is just the same in many cases as any other gambling pursuit, with the added bonus of arguably being the most complex environment. We often use sort of analogies like, trading is sort of, if you want to make a trading equivalency to say poker, for example. Imagine being a sharp poker player in terms of mathematically speaking, understanding pot odds and understanding position at the table and understanding where your edge lies in certain situations and how best to play the game, even if you take the human element out of it. Well, now imagine that you're sitting at, say, a hold'em table or whatever, and somebody introduces the new rule to the game, which is that everything else about the game of hold'em is exactly the same, except that at any given point and any second on any turn of the game, any and all players at the table can change their hole cards. How do you like it now? How do you like your calculation of odds and your position and all those certain, how do you even play the game anymore? What's ultimately going to be really important to your survival is going to be that risk and bankroll management, those aspects of your game. Critical to it. It's just, you're never in a position where you know almost for certain that you have the best hand, right? And that's really what trading is about. So you have to take all that stuff in stride. Groups of trades over time, remembering that the deck's always being reshuffled, and not getting, the main thing is not falling into that trap where, because you don't have an adaptive risk model, because you don't recognize these things, that you have some pattern-based thing that either you figured out yourself on the last year's worth of data, which is inconsequential. Markets are always evolving and changing, and you can find some kind of a pattern that's been really great for the last 12 months, and then all of a sudden, with that particular a pairing of risk model or bankroll management context that you have with it, it doesn't work at all for 3 months in a row. And then if you don't have a risk model that's resilient to variance in the outcome of your occurrences, you either end up blowing up, which is the worst case scenario, or maybe even worse, that you just bounce over to something else, which, oh no, now I've got it. Now this is the best thing, and that works for a while, and then it doesn't, because you've never kind of gotten the message that you need to be adaptive. So that's really the main message that I wanted to get across. And then I wanted to draw your attention to this, for those of you guys who don't know, and I'm going to kick off a little early so I can see the fireworks here at 2 o'clock. I want to draw your attention to the bootcamp trial page that we have. NJ will be posting links to that page, which you guys will have access the whole time that the boot camp is open. It's basically just a mirror of our portion of some of the daily content that we have in the community, so you can get an idea of what we do, how we trade. You'll see that every morning NJ posts our plan sheet, which includes our market structure reads for the S&P, the levels that are going to be important. The first let me, if you look on this bootcamp page here, if you look on the sheet and sheet and print share there, I have what the sheet looks like up on there. So everybody's seen these 1,000 times before. Everybody's got these now. We've noticed that kind of explode. Everybody's got a plan sheet with levels on it these days. This is what ours has looked like since the beginning. Obviously, you see some sentiment context on the sheet, what smaller traders and larger traders are doing, if those things are different, what the big picture is of what's going on with the news, general market context, any events that are happening for the day. And then if you look at the section below, sometimes the first reaction to this is, geez, why so many levels? It's like everything is a potential level. Well, the reason is because this is all the part of this big context picture that we really believe in. People trade all sorts of different ways. Some guys trade with much larger targets. They're in trades for the day. Some guys are scalpers, in a loose sense of the word. Some are pure market makers or liquidity providers trading for ticks. So depending on what your general periodicity as a trader, some levels are more major than others. So there's, our goal is just to point out everything that is important structurally. We basically take the key prices and put them as bookends, and then try to form some kind of a loose zone in between that allows for, obviously the market doesn't go straight to a level. It either early rejects it or spills a little past it, as we call it. And it just gives you, these ideas of windows that we think could potentially be important for various strategies, depending on how people are trading. And we're very interested in crowd behavior that is devoid of time frame. So any structure, market structure that we're interested in is a structure that's not something that you only see on a 5-minute chart or a 1-minute chart. It's something that's visible and likely where participants of all periodicities, from position traders to swing traders to intraday traders to scalpers to market makers, are going to be interested in. So when traders use these sheets, they use them in different ways. But we post the key prices that are important to us. Obviously, any comments that are related to the importance of the structure. Obviously, dates of where it's derived from. These places draw crowd behavior. There's no secret sauce here. There's no big, these are the key, the great whatever that we know and nobody else knows. The idea is that they're levels that everybody has their eye on, not that we created out of thin air saying that, our level, these are our levels. I mean, this is ridiculous. Crowd behavior. I want to know about the places in the market that everybody has their eye on. Why? Because I think it's a great place to buy or a great place to sell ahead of time? No, but I want to know what they are ahead of time because I know that they're going to draw crowd behavior. What that means is that a lot of sellers and a lot of buyers are going to look to do whatever they're going to do that supports their particular thesis for their position around known areas. I mean, human beings are creatures of habit. They see a major structure in the market and they go, well, if it gets below here, I don't want to be long anymore, and so on and so forth. So, and then other people say, if it gets to here, I think guys are going to short it and get trapped, so I want to trade against those guys and run them over, on a reversal or whatever. Strategically, all the participants are doing different things, but we're interested in the fact that whatever they're doing, they're going to have eyes in these areas. And what that means to us is that that density of participants means that for whatever the given strategy is, that it's going to be an area in the market for your strategy where you're going to be able to theoretically have the lowest possible risk for the greatest possible reward if you're right? If you're right. Not, this is the level to short. We don't talk in those superlatives. It's absurd. It's an area that's going to attract attention. And if for your particular trading strategy with your particular bias, with your particular context at that time. And that's what we do at DTG. Everybody develops their, unique strategies, talks about how they're going to have a risk model that's going to be adaptive to that particular strategy and suit that strategy. And, they work it out, they journal, everybody communicates, talks to each other, and work, well, what about this? Have you considered this? All that sort of stuff. So, but the fact that it's attracting all those participants, we found over time for almost every strategy has been a very good starting point for the development of that ever important risk overlay that you're going to have on your strategy. So anyway, I don't really need to belabor the point, but DTG is a really unique place. While we do have a methodology white paper which outlines the key components of the types of market structure, price action, and order flow components that most members are interested in pursuing to varying degrees, some much more focused on the specific order flow stuff, some more on the bigger picture market structure stuff. Obviously, that's a function of periodicity, what tends to bear the most fruit, and the risk model. But so while we do have that framework, which gives those of you a starting point, if you're really wanting to kind of start from scratch and go down that road of building a methodology that draws from those concepts, market structure, price action, order flow. There's that, and then there's people that just do their own thing that are really more interested in the mentorship aspect of hearing from a pro perspective what avenues are worth pursuing and what aren't, some of which from our experience in the quantitative arena and so forth. But the real key is it's very active. The members are all journaling and sharing what they do and getting that feedback, and we're very proud to say that we've just had many great success stories over the years that have gone on to be really get it and become very successful and hold pretty prestigious positions in the industry and so on. So if you really want to dive hardcore into developing a process and a risk model that's adaptive, that will give you what you need to make it in the long haul, it's a good place to be. Not the only place to be, but wherever you are, you need to be paying attention to the stuff that we talked about today, because it's what's really going to matter, not whatever the whiz-bang cool thing to do to enter the market is today. That's not going to get you the cheese in the long run, I assure you. So let me. Yeah, and NJ has posted the link to the trial, so every day you could see the sheets and the comments on the sheets, and then the annotated examples of one of the trade ops for the day. Typically, those are either what we call intraday swing ops, trading from key market structure to key market structure, sort of a few points to each scale point type of illustration. But of course, from what I just said, you've gleaned that there's a million different ways to absorb sort of the information that's from those examples, and that's why they're pretty agnostic in that from that standpoint, just showing you that these same things occur over and over and over again at these predictable spots in the market that draw this attention. And you could kind of see what everybody did, who's trapped, who's not. And then, of course, you have to fit how that's going to fit into the context of your particular risk overlay. So that's kind of the goal of the daily examples, of just showing this repetition over and over again, which we staunchly believe in. So let me stop there, and I'd love to answer any questions that anybody has, because I never have time to do that. Yeah, we do. We just I just did uh, an event with I wanted to start a series where I actually interview / talk to DTG members, and because the membership is so diverse. Um, and you'll see why if you watch the first video that's on our, people laugh at us. We've been around for whatever it is now, 7 years, and we've never really marketed, and we just finally have a little YouTube channel because we had an excuse with this video to put up. So so we're happy about that. And this first event is me talking to one of the members who is very different in his approach from the typical members, and we thought that would be kind of an interesting way to kick off the series of where I talk to members of what they do and what their experience is, and how they're getting through this process of developing themselves as a trader. So check that out for sure, and I think you will hear a lot of the same stuff probably that I talked about here, or us alluding to that stuff. So, oh, is that right? I didn't know that. To have 100 subscribers before we can name the channel. So any questions, guys? About anything? Order flow, market structure stuff, whatever, anything. Crickets. Yeah, I don't know. No questions? Not maybe nobody's listening. You're welcome, Clint. Come see us. Thank you. Yeah, that's true. I had forgot about that for a second. Um, everybody's waiting for the mighty Fed fireworks. So yeah, so this week, email us. No, I'm not. We're not. I have a lot of thoughts, but I don't have enough time to go into all of it, particularly related to the curve, and but we don't tend to be predictive. We have everything that we do is planned ahead of time. If the market does this and it gets to here, if this context is still relative, we will look to do this. So I look at charts once a day, and based on what's going to happen that day, I have an opinion about where I'm interested in what happens, and then I never look at it again. I never look at anything but my execution, and I have alerts, and when it gets there, I sit down and I see if I want to go to work, and that's it. So I'm not ever saying, well, I think I'm a bull this morning, and I want to buy the market here or whatever in real time. It's always waiting for the market to do something and get somewhere, and then react if and when that happens. So it's a very non-predictive approach. But finally, the last comment, 3 minutes left here. Whatever you do, and I support Danny fully in this. Danny says, don't trade in the closet. You have to interact with people. For you to just be alone with your thoughts and your charts and, looking at stuff, trying to come up with a trading strategy, you can be your own worst enemy. So whether you're in a community like ours, where it's just this, circular mentorship where everybody's working with each other and developing something on an ongoing basis, or whether it's in the IM Pro room, watching where everybody's trading and following their lead. I'm not advocating that either one is right for you necessarily, or not, but you want to be in an environment, even if you're on a Skype with your 3 buddies or whatever, definitely share ideas in some capacity, either in a huge way like we do all the time at DTG, or in a very real-time way like I Am Pro, or just with yourself. You know, I think that's really, really important. So, all right, guys, 2 minutes, T-minus. So hopefully that that was worth something to somebody, and just hit us up this week if you got any questions. Sayonara.